India's April-June current account deficit or CAD came in at $23.9 billion or 2.8% of GDP. This was much higher than the $13.4 billion or 1.5% of GDP reading in January-March 2022. In FY22, the CAD was 1.2% of GDP or $38.7 billion. But this may come as a relief as analysts and agency reports expected the CAD to hit a 9-year high of 3.4 to 3.7% of GDP. Nonetheless, the Q1 FY23 CAD reading represented a 15-quarter high, driven by an elevated merchandise trade deficit. The expectation in various quarters is that the deficit may remain elevated in the second quarter too, amid the slowdown in exports growth and the depreciating rupee. There were also apprehensions that the CAD could widen all the way to 5.5% of GDP in the second quarter, which would be the second worst quarterly deficit on record after the 6.8% reading in the third quarter of 2012-13. One agency had estimated that for the entire year, CAD could widen to a decade high of 3.8% of GDP in 2022-23. According to a Kotak economic research report from Friday, the external sector risks remained high. The report said that overall, the balance of payment or BOP in Q1 FY23 was marginally positive, with the lower than expected CAD being one reason. However, it said that as global slowdown risks were increasing, the agency was raising its FY23 CAD estimate to 3.9% of GDP from 3.4% earlier. This is a cause for concern, since the RBI believes that India can sustain a CAD in the 2.5 to 3% range without getting into an external sector crisis. So, how are things likely to pan out for the full year?
So we're looking at a number of something like 3 to 3.5% for the entire year.
According to the Reserve Bank of India, the country's forex reserves continued their southward journey, declining by $5.219 billion to $545.652 billion for the week ended the 16th of September. The central bank's bid to stall the rupee's decline against the greenback has been responsible for this fall in reserves. However, experts reportedly said that the decline in foreign exchange reserves was not a worrying factor. They said that there was coverage for 9 months of imports. At a peak of $642 billion in October last year, the reserves had been sufficient to cover 16 months of imports. Still, worries persist. A recent Reuters poll found that India's foreign exchange reserves were likely to drop another $23 billion to $523 billion, falling to their lowest level in more than 2 years by end 2022. This would mean a further shrinkage in the import cover too. The rupee has depreciated about 8.4% against the dollar so far this year. According to the Kotak economic research report, the rupee is expected to remain under pressure as markets continue to assess the extent of spillovers on the emerging markets currency space from the US Fed's aggressive tightening, the European crisis, and geopolitical risks. However, for its part, the report expects the RBI to become more prudent in the second half of FY23 while intervening in the currency market. According to the RBI, underlying the Q1 FY23 CAD was the widening of the merchandise trade deficit to $68.6 billion from $54.5 billion in Q4 FY22 and an increase in net outgo of investment income payments. There has been an upward pressure on India's import bill because of the Russian invasion of Ukraine. There are some bright spots too. Some of the pressure from external sector headwinds has been easing of late. This has come with the RBI's monetary policy being in sync with the global policy stance. Commodity prices have also fallen from their recent peaks, and there is stability in capital inflows. Delivering the MPC report on Friday, the RBI Governor said that services exports and remittances could narrow the trade deficit. The Governor said that services exports did very well in July and August this year, and they grew at a robust pace of 35.4% year-on-year during April-June. For the same period, remittances also rose by 22.6%. Das also said that while the Indian basket crude oil price was around $104 per barrel in the first half of FY23, the RBI was now assuming it to be $100 per barrel in the second half.
The current account is going to continue to be under pressure primarily on account of the trade deficit. Given the fact that India is one of the faster growing economies in the world at 7%, going by what the RBI has projected, it would mean that the demand for imports would go up. Now, our exports, on the other hand, would probably be in a negative zone in terms of growth or marginal growth, if at all we cross the positive, get into a positive territory. Reason being that our exports are more dependent on the global economy. And if there is going to be a recession in the West, that would actually get reflected in terms of slower growth in India's exports. The crux actually would be as to what happens on the capital account. Now, here I think the picture is not very clear because we have seen certain months where the FPIs have been positive, certain months where they've been negative. And I think the FPI would hold a clue as to whether we would be able to balance a balance of payments, that is our external account, in a more positive manner. What the RBI governor has mentioned, where he said that 2/3 of our reserves value, which has come down, is due to valuation reasons. So that could be the driving factor in bringing the reserves down. But on the whole, there would definitely be a subtraction in our foreign exchange reserves. The vulnerability of our external account will definitely increase, primarily on account of the fact that the CAD is going to widen. And the FPIs will be quite uncertain because they have been volatile in the last couple of months.
As the Kotak Economic Research Report said, capital flows will remain the key risk to BOP deficit. The RBI will need to keep its policy in tandem with its global peers to avoid a capital flight.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.